We have seen an incredible rally in both gold and silver prices over the past 12 months, with many European investors understandably feeling like they're missing out and wondering, is now still a good time to buy? If you're new here, my name is Angelo, and I've been investing in globally diversified ETFs for over 9 years together with my wife, with the goal of being able to retire early one day if we so choose. First things first, I personally don't own any gold or silver right now. My only exposure to precious metals is via the market cap weighted global ETFs I hold, which includes whatever mining companies happen to be in those indexes. But that's indirect exposure to those companies, not to gold and silver directly. Instead, I have maintained a small allocation to Bitcoin, which I thought of as a form of digital gold but with much higher risk. And don't get me wrong, that decision has worked out very well for us since 2017, with my wife and I taking out our original investment several times over since then. Having said that, the last couple of months have not been easy. While gold and silver were rallying in price overall, Bitcoin crashed and is currently down 45% from its highs. If Bitcoin was indeed meant to serve as a digital alternative to gold, then I would have thought that the current market environment with all the uncertainty and currency debasement around the world should have been the ideal scenario for it to shine alongside gold. Sadly, that didn't happen, with the Bitcoin to gold chart moving back down to October 2023 levels. And while this may be simply happening because of its historical 4-year cycle, where it tends to crash and bottom in year number 4, watching all of this unfold has still been very disappointing. And it has made me reconsider if having a tiny allocation to actual gold could indeed make sense long term for extra diversification and as a small hedge. So let's look at gold and silver as objectively as possible, not from excitement or fear of missing out, but by looking at what actually drives these assets, how they've behaved in the past, and whether they really deserve a spot in a long-term portfolio. Let's start by looking at why these precious metals have been rallying so hard recently. Over the past 12 months, gold is up as much as 70% and silver has jumped 134% higher in US dollars. Those are massive moves, driven by several things coming together at the same time. First, uncertainty. Geopolitical tensions have been rising. Inflation concerns haven't disappeared just yet. Government debt levels keep growing across developed economies. And when people worry about the stability of currencies or the financial system, some of them turn to assets that they view as safe havens. Second, major central banks like China have been buying large quantities of gold on a monthly basis, in some cases as an alternative to US treasuries to reduce their reliance on the US dollar. This created structural demand that wasn't there before to this extent. And third, investment flows from retail investors and speculators once gold started breaking all-time highs. In fact, gold ETFs saw their strongest flows on record last year, with momentum carrying over into 2026. Meanwhile, with silver, the story was slightly different. It's less of a reserve asset compared to gold, so central banks aren't buying it in large quantities. The rally was largely driven by rising industrial demand for solar energy, electric vehicles, AI and data centers, and of course, quite a bit of speculation. That's because historically, silver tends to move even more aggressively after gold moves. But here's the thing, explaining why gold and silver have likely gone up doesn't tell us anything about what they're going to do next. And that's where recent price action and a look at their long-term history can provide some perspective. Let's start with what actually happened recently. Gold is often described as a safe, almost boring, relatively stable store of value. But the thing is, it's not actually less volatile than popular stock market indexes on average. Something that became very clear at the start of February, when gold fell as much as 21%, and silver crashed 40% within a very short amount of time. And compared to the MSCI World and the S&P 500 index from 1992 to the end of 2025, we can see that gold's volatility or standard deviation has been very similar on average. As for silver, it had almost twice the volatility at 27%, while both precious metals had a lower Sharpe ratio compared to the MSCI World or S&P 500 stock indexes. The Sharpe ratio measures risk-adjusted returns. Basically, how much return you got for the risk or volatility you experienced. A higher number means you got more return, per unit of risk. Now let's look at longer periods. Because while gold can rally dramatically over short stretches, its long-term performance has been far more uneven than many people realize. For example, if you bought gold in 1980, you had to wait 27 years until 2007 just to break even again. And silver becomes a lot less impressive overall once you realize its price was $36 in 1980 and is now quote-unquote only $76, meaning it only grew 1.7% per year since its 1980 peak. For me personally, that makes silver a lot harder to justify as a long-term holding. Meanwhile, if we compare gold to stocks over almost 100 years, we can see that it delivered a respectable annual return of 5.6%. That's quite a bit lower than the 10% from US stocks or the roughly 8% from world stocks, but still respectable, beating bonds, housing, cash, and US inflation since 1928. If we break it down by decade, again using US data, there were definitely periods where gold significantly outperformed stocks, but also many decades where US stocks strongly outperformed while gold disappointed investors. Keep in mind, all of this is just historical data and the future remains uncertain. Gold tends to shine during specific macro environments like high inflation or periods of crisis, but it can lag significantly during more stable, growth-driven decades. If the primary goal is building wealth over 20 or 30 years, stocks have historically been far more reliable, with gold being a lot more cyclical. In my view, gold is not meant to build wealth. It's meant to help preserve real purchasing power. There's a famous example that helps illustrate this perfectly. In the 1920s, 1 ounce of gold worth $20 back then could buy you a high-end tailored suit. And today, 100 years later, 1 ounce of gold at around $5,000 still buys you roughly one high-end designer suit. Gold maintained your purchasing power, but it didn't make you wealthier. Meanwhile, if you had invested in productive businesses instead, that same amount could have compounded into something far greater. That's the fundamental difference between gold and equities, which again makes sense. Gold is just lying there as a store of value, but it's not producing anything. That's why it often performs well during high inflation, currency instability, geopolitical stress, or periods when confidence in financial assets weakens. It behaves differently from productive assets like stocks. And that difference is exactly why some investors choose to include a small allocation. The other argument for gold is diversification, due to its historically low correlation to stocks. That means when stock markets drop sharply, gold doesn't always move in the same direction. Sometimes it even rises during periods of stress. Some withdrawal strategies include a small gold allocation for exactly this reason. The idea is that if you're drawing down from your portfolio during a market crash, you could sell gold instead of stocks, reducing the pressure to sell equities at lower prices. But the key word here is small, since gold's job is not to replace stocks or to outperform over long periods. It's meant to smooth out the ride or provide psychological comfort during uncertainty. That's why if someone chooses to include gold at all, I personally wouldn't go beyond 5 to 10% of a total portfolio. Enough to potentially help during rough periods, but not enough to drag down long-term growth if gold underperforms for years or decades, which it absolutely can do. So if someone decides that gold deserves a small place in their portfolio, how do you actually buy it? If gold is meant to serve as a personal insurance outside the financial system for whatever worst-case scenario you envision it might be useful for, then buying physical gold coins or bars at a trusted gold dealership probably makes the most sense. But if it is meant to be part of a diversified investment portfolio that can easily be rebalanced within your brokerage account, many investors in Europe choose physically backed gold ETCs. There's a long list of them on ETF comparison sites like Just ETF, and they can be found using their ISIN number or ticker symbol, using your broker of choice. In case you're wondering, ETC stands for Exchange Traded Commodity. And based on my own research, some brokers like Interactive Brokers offer a wider range of gold ETCs than others. Either way, you can find all my favorite low-cost brokers in Europe that offer both ETFs and ETCs linked down below, which is a great way to support me if you'd like to. So, Where does it leave me personally? At the moment, I still don't own any gold, but I have to say that the last 2 years have made me more open to the idea of adding a small allocation. Not because I think gold will outperform stocks, which I find very unlikely based on history, but because it could help diversify our portfolio further due to its historically low correlation to stocks over the long run. If I end up adding gold, something I still have to think about, it would likely be with an allocation of around 5% and most likely through a gold ETC for simplicity. As for silver, for me it's too speculative and too unpredictable, so it's not something I would feel comfortable holding long term. I already have a small high-risk allocation to Bitcoin serving that purpose for me personally, which I'm planning to hold on to. Either way, for my wife and I, global ETFs will remain the pillar of our long-term investment and retirement strategy. So, should you still buy gold or silver in 2026? Honestly, it depends on what you're trying to achieve. If you're planning to build wealth over the next 20 or 30 years, stocks have historically been far more effective and reliable. But if you're looking to add a small diversifier that tends to behave differently from equities during certain types of crises, gold could potentially make sense, as long as you understand what you're getting into. Just keep in mind that even though gold may appear to be safe, that doesn't mean it's stable, as its volatility is very close to stock indexes. It's by no means a low-risk investment like highly rated Euro government bonds. And buying something simply because it recently went up a lot is rarely a good long-term strategy. Markets have a way of making the recent past feel permanent, but long-term investing requires zooming out. Now I'd be curious to hear your thoughts. Do you own any gold or silver, and why? Let me know in the comments. You can find links to my favorite low-cost brokers in Europe below, which is a great way to support me if you'd like to. And if you've been looking for simple ways to reduce your ETF portfolio's exposure to US stocks, make sure you watch this video next. As always, none of this is meant as investment advice. I'm just sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.